Welcome to FT Markets. The question today is, what is normal? Is the growth that we have as good as it gets? And when it comes to markets, what do they think about it? Is it really possible that European stock market investors are predicting 20 years of stagnation ahead? To help us think about these questions, we're joined today by Peter Oppenheimer, Chief Global Equity Strategist for Goldman Sachs, who's going to help us have a look at some of these issues. So Peter, first let's talk about the background, where we are. We're in what might be called a pretty tepid recovery around the world.
Right.
And so I think you've brought a first chart here, just to put the strength of this recovery in context.
Absolutely. Well, as we look at things right now, the world is a little bit split. Things are looking pretty good in the US, fairly tepid elsewhere. But it's worth noting that even in the case of the US, the recovery we've seen so far is pretty modest by the standards of previous recoveries from recessions. And this chart, the line at the bottom, is showing the recovery we've seen so far from the end of recession, and the other lines, the previous recoveries from other post-war recessions. So it has been pretty tepid. 5 years into that recovery, interest rates have yet to rise. That's not a normal world.
And I think sort of pretty modest being pretty generous to what we can see looks like the worst post-war recovery that the US has experienced. But the strange thing, though, isn't it, that sort of whilst this isn't very good in economic terms, this has been pretty good in terms of market terms, haven't they? Sort of asset prices have been great.
Right, and this is what we call the wonderland, in a sense, that you've had very low growth, but with it very low inflation and pretty much zero interest rates. And that's created a wonderland where asset markets have benefited significantly. You've seen asset price inflation, not consumer price inflation. Equities globally are up and annualized around 20% over the last 5 years. Credit and bond markets have also done very well. So the question really is where they go from here and how the market prices that.
Through the looking glass indeed.
Right.
Now, I think if we take a look at your next chart, you were saying that, so could you perhaps talk us through what's going on here? Because it seems like nothing much has really happened, but I think you talk about mini cycles in the context of the market at the moment.
So if we look at this time last year, there were hopes of a strong economic recovery globally. And over the course of this year, growth expectations have come down, global growth around 3%. Well, that's pretty much what it was last year and the year before. But when you have low growth and rates and inflation, there's a fine line between it being seen as very positive and benign for assets and also potentially quite negative, particularly if you get trapped in stagnation and deflation. This is just showing how you've seen some of these mini cycles just in the last year. So autumn of last year, the red line is showing that bond yields were rising in the US, equity markets were also rising. That was seen as a good rise in bond yields. Confidence was increasing. We hit the beginning of this year and you can see that bond yields collapsed, equity prices fell, there was a growth scare. Central banks became more dovish again, and that stabilized conditions. And from the spring through to October of this year, equity prices were rising comfortably and bond yields were continuing to come down with low inflation. Recently we've had another growth scare, another fall in bond yields, another fall in equity prices. But underlying all of this, the economic conditions haven't really changed. It's just modest perceptions at the margin that have shifted these things.
So it's the shift in sort of investor sentiment which is changing rather than anything fundamentally underlying what we're seeing.
So. Yeah.
Which I think brings us to sort of the final point about just what is baked into sort of markets in terms of what investors are expecting. So the final chart we have here is, it shows something called the equity risk premium, which for those who don't understand is sort of the return which investors are demanding over and above that which they might get from very safe government bonds. And I think what you've done here is you've backed out sort of from market prices and some assumptions about that equity risk premium, about what investors are saying about growth overall.
Right. And this we've chosen to show the picture in Europe because things are more extreme in Europe. There's less confidence, so a higher required risk premium baked into the market. People don't have confidence that you'll get recovery and avoid stagnation or even deflation. So this line is showing the market's implied future profit growth annually for 20 years. And you can see that on a fixed risk premium, assuming that is not changing over time, implied growth has fallen to really quite negative levels. This is really consistent with the market pricing in a high probability that you get another Japan type of stagnation with deflation. You don't need things to get much better to get a positive response in the markets.
I mean, 20 years of stagnation, that does seem a somewhat extreme
Well,
measure.
we've already seen almost 10 years of it. And it's true that, if you look at our profit forecasts, even as they recover in Europe, we wouldn't get back to the 2007 peak until about 2017. So it is certainly a period of stagnation, but history would suggest that that's not necessarily very bad for asset markets, even equities, as long as you avoid deflation. And the uncertainty about this is still leading to this high risk premium, which will in time, I think, create opportunities.
Brilliant. Thank you very much for that, Peter. So things are still looking like they're not really going to change. That's what stagnation means, but there might be some optimism there for investors.